6 months ago, Melbourne was supposed to be the best housing market in Australia. KPMG forecast growth of around 6.5% for 2026. Domain modelled a median house price of $1.17 million by December. Agents were calling it Melbourne's year. Then the Reserve Bank raised rates 3 times, and according to Caudality's May data, Melbourne's median house value just fell nearly $10,000 in a single month. So the recovery everyone was promised has stalled. But here's the strange part. Some of the smartest money in the country says this stall is exactly the window buyers have been waiting for. Let's break down what just happened, what the numbers actually say, and how to think about timing your entry before the next leg up. Quick one before we get into it. I cover the Australian housing market with real data, no hype. If that's useful, hit subscribe so you don't miss the next update. Alright, here's what actually happened. Through late 2025, Melbourne finally looked like it was waking up. The RBA had cut rates by 75 basis points during the year. PropTrack data showed Melbourne house prices rising $59,000 over the year to November, pushing the median past $1 million. Agencies like Woodard's reported record sales months. Some suburbs went vertical. Domain data showed Heidelberg house prices up almost 26% year on year, and Carlton North up over 21%. Buyers who had waited 3 years started jumping in. Forecasters piled on. KPMG tipped Melbourne as the top capital city for 2026. SQM research saw national prices rising 6 to 10%. Then the script flipped. Inflation picked up hard in the second half of 2025, made worse by the conflict in the Middle East pushing oil and energy prices higher. The RBA responded with 3 straight rate hikes in early 2026, February, March and May, taking the cash rate back to 4.35%, its post-pandemic peak. Headline inflation was still running at 4% as of May. Borrowing capacity got cut, buyer confidence got cut with it, and the Melbourne recovery, barely 6 months old, went into the freezer. But that's just one part of the story. The numbers coming out right now paint a more complicated picture. As of May 2026, CoreLogic puts Melbourne's median dwelling value at roughly $812,000. That's down 2.3% over the quarter. Annual growth is just 0.5%, the weakest of any Australian capital city. Houses are getting hit harder than units. The median house value sits around $958,000, down almost 3% for the quarter. Units are basically flat at around $637,000. And here's a detail most headlines miss. The pain is concentrated at the top. CoreLogic data shows the upper quartile of the Melbourne market fell 3.7% in just 3 months. The bottom quartile? Down barely 0.1%. Expensive homes are falling. Affordable homes are holding. Auction results tell the same story. In June, Melbourne cleared around 55% from just over 500 auctions, better than the 48% the week before, but still well below the 70% range that signals a seller's market. Reports say some properties above $2 million are selling for hundreds of thousands less than comparable results from late 2025. Meanwhile, investors are pulling back, leaving owner-occupiers in control of both sides of the market. Homes are taking around 30 days to sell, vendors are negotiating, buyers have leverage they haven't had in years. The market cooled fast, and that's exactly why the timing question matters. Now, let's talk about why some analysts are calling this a strategic entry window rather than a warning sign. First, the value gap. Melbourne's median house price is now more than $600,000 below Sydney's, a historically wide discount. Caudality figures show Melbourne values are still sitting about 3% below their March 2022 peak, while Brisbane, Perth and Adelaide have all pushed to record highs. Melbourne missed the boom, which means on paper it's the capital with the most room to move. Second, the rental market is brutally tight.
Vacancy in Melbourne is sitting around 1.4 to 1.5%, according to Cotality. Rents have kept climbing even while prices softened. That's not what a broken market looks like. That's what an undersupplied one looks like. Third, the fundamentals haven't moved. Melbourne has the fastest population growth of any Australian capital, projected to hit 6.2 million residents by 2030. There's a massive infrastructure pipeline, headlined by the $12.7 billion Metro Tunnel, scheduled to open in late 2026, with 5 new stations. Some commentators argue Melbourne today looks like Brisbane and Perth 3 years ago, an underperformer right before a major run. Investment advisors at firms like InvestorKit describe the current setup as a genuine entry window for anyone with a 7 to 10 year view. But not everyone agrees, and the disagreement matters. ANZ research expects Melbourne house prices to fall around 1.7% across 2026. Domain's forecast for the year to June 2027 is even more cautious. Houses down 4 to 8%, units down 1 to 3. The spread between the big bank forecasts is wider for Melbourne than almost any other capital. Even the professionals can't agree on the bottom.
If that sounded messy, here's how to cut through it. There are 3 signals worth watching. Number 1, the Reserve Bank. This entire cycle turns on rates. The RBA has now paused, holding at 4.35% in June and again in July. CBA economists expect rates to stay on hold into 2027, with a possible cut around May. History suggests markets that lagged during tightening, like Melbourne, tend to respond fast once cuts arrive. If you wait for the first cut to be announced, you'll be competing with everyone else who waited too. Number 2, auction clearance rates. Right now, Melbourne is in the mid-50s. When clearance rates push sustainably back towards 65 or 70%, the buyer's market is over. Watch that number weekly. It turns before prices do. Number 3, the 2-speed split. Units and affordable houses are holding their value, while the premium end falls. If you're a first home buyer, that's a mixed blessing. The cheap end isn't getting much cheaper. But if you're upgrading, this may be the best relative discount on quality family homes Melbourne has offered in years, with the top quartile down nearly 4% in a single quarter. The honest answer on timing is this: nobody rings a bell at the bottom. But right now you have soft prices, motivated sellers, 30 days on market, retreating investors, and a rental market screaming undersupply, all at the same time. Conditions like that don't usually last long once rates turn. So here's where it lands. Melbourne's recovery didn't die in 2026, it got delayed. The forecasters are split, the Reserve Bank is on pause, and the window between market is weak and market has turned may be measured in months, not years. That's why homeowners, renters, and investors are all watching Melbourne right now. Do your own numbers. Talk to a professional before you commit. And if you want to follow what happens when the RBA finally moves, subscribe, because that's the moment this whole story changes. The market is shifting faster than anyone expected. Don't get caught watching from the sidelines.